All right, welcome to the Explainer. If you've been feeling like the market is on an absolute roller coaster lately, well, you're not wrong. So let's just dive right in. This is your essential guide to navigating the market volatility of 2026. So, does checking your investment portfolio feel like, I don't know, strapping into a roller coaster these days? One day it's way up, the next it's plunging down, and it just leaves you with that feeling of market whiplash. Yeah, you are definitely not alone in feeling that. Okay, so in this explainer, we're going to break down exactly why the market feels so unpredictable right now. And probably more importantly, we're going to talk about what you can actually do about it. The goal here is to get you from feeling confused to feeling clear with a solid plan in hand. Okay, so let's start at the beginning and make sure we're all on the same page. When we throw around a word like volatile, what do we actually mean? It's actually pretty simple. It's just a measure of how much and how fast prices are changing. So think of it this way. When prices are swinging all over the place in a really short amount of time, that's high volatility. When things are pretty stable and not moving much, that's low volatility. And right now, yeah, we are definitely in a period of high volatility. So that leads to the big question, right? What is causing all this shakiness in 2026? And the answer is, it's not just one thing. It's really a combination of some powerful forces all colliding at once. Just take a look at these 6 key drivers. And remember, they're not happening in a vacuum. They're all kind of feeding off each other. First up, you've got this massive spending on AI. That's pricing in some huge expectations for future profits. So any little sign that reality might not live up to the hype, boom, you can get a sharp correction. Then there's this stubborn inflation that just won't go away. That keeps the pressure on central banks and their interest rate decisions, and that creates uncertainty for, well, everyone. Then you throw in the political uncertainty of elections, which makes future policy a total question mark, and you've got shifting global trade making supply chains fragile. But here's the real kicker. All of this is happening while stock prices started the year at really high levels. That just means there's less room for error. It's like a perfect storm for volatility. Yeah, let's zoom in on that sticky inflation for just a second. Central banks, they're typically shooting for a 2% inflation rate. The fact that it's hanging around 3%, that means businesses are paying more for everything, materials, labor, and that directly squeezes their profits. And when profits get squeezed, investors get nervous. And this is a perfect way to think about those high valuations. When the market is stocked this high, priced for perfection, it becomes incredibly sensitive. It's like a Jenga tower. It means that even the tiniest little nudge of bad news can cause the whole thing to come tumbling down, and way faster and harder than it normally would. Okay, so that's the big picture stuff. But how does all this economic news actually travel from the headlines all the way down to your wallet? Let's trace that path, let's connect the dots. So here's how that chain reaction really works. It all starts with a trigger event, right? Let's say a higher than expected inflation report comes out. Instantly, investors react. Their brains go, okay, this means central banks are going to keep interest rates high. That fear causes a sell-off. Traders and, these super fast computer algorithms, they all rush to sell stocks to avoid risk. Then you look at your retirement account and see it's lost value, and naturally, your confidence drops. And what happens then? Well, people tend to spend less, which, you guessed it, ends up hurting the profits of companies down the line. It's this really powerful cycle that feeds on itself. And right in the middle of all that chaos, it is so important to remember this. Those daily price swings, the panicked selling, that's all just short-term noise. It often has very little to do with whether a company is actually a strong, valuable business for the long haul. So if we can't control the headlines, what can we do? This brings us to the most important part of this whole explainer, your game plan. It is all about focusing on the things you can actually control. This slide just lays it out perfectly. It shows the 2 paths you can take. Over on the left, you've got the emotional reactions, letting fear and greed drive your decisions, trying to outsmart the market. And on the right, you have the informed, disciplined strategies, things like diversification, consistent investing, and focusing on long-term value. I think you know which path is the one that builds resilience. So what does that informed strategy actually look like in practice? Well, it's basically a 4-part plan. First, you diversify. Don't put all your eggs in one basket. This protects you from having all your money tied up in one overheated sector, like AI right now. Second, keep some cash reserves. Having an emergency fund means you won't be forced to sell your investments when they're down just to cover an unexpected bill. Third, invest consistently. This is called dollar cost averaging, and it's a great way to smooth out the bumps of a volatile market. And finally, and this is a big one, you gotta reframe your thinking. A market drop isn't just a threat, it's an opportunity. It's a chance to buy great companies at a discount. And just as important as what to do is knowing what not to do. First, avoid trying to time the market. Seriously, it's a fool's errand. Even the pros can't do it consistently. Second, resist emotional trading. Don't get bogged down in the daily noise, and be super careful not to concentrate all your money in one place, no matter how exciting a sector like AI might seem at the moment. This quote, it just says it all, doesn't it? Fear causes you to sell at the bottom. Greed causes you to buy at the top. These two emotions are, without a doubt, the greatest enemies of a successful investor. Just understanding that is half the battle. And this really brings us to the most crucial point of all. You can spend all your energy lost in the fog, trying to predict the future, or you can prepare for it. The goal isn't to outsmart the market. It's to build a financial plan that's resilient enough to handle its ups and downs, because those are inevitable. That is how you win in the long run. And that leaves us with one final question to chew on. In a really volatile market, what's the bigger risk? Acting rashly and making a panicked decision, or not acting at all, being so paralyzed by fear that you just abandon your long-term plan? Something to think about as you navigate the road ahead. Thanks for tuning in.